So I have this very august panel, and I will now try and get a perspective on from the CEOs on the business of passives. So one of my concerns is the fact that passive funds are low margin products. So does the rise of passive funds really give you sleepless nights because your bottom line gets affected? If today passives form about 17% of the industry's total AUM, if it keeps growing, then you are dealing with low margin products, right? And hence that means lower profitability. So how do you look at the growth of passives as a challenge, as an opportunity?
My view is a bit different. I think when you look at the margins in active versus passives, that's a debate always. But my belief is that if you look at a fixed income, it is also similar. In that sense, it's much more lesser than the passives, if you really have to look at. And if you're able to launch a couple of products which are beneficial for customers and able to get better margins, it makes a lot of sense. Second point I want to look at and say that is that passives is part of our customer allocation. Our job is to manufacture products, which is right for the customer. And as advisor's role is to make sure that you advise right thing to customer. In that sense, it becomes a part of your strategy to build that product. It is just not to say that I'm only going to do an active. Now, passive also plays a critical role in the customer's portfolio. In that sense, as a manufacturer, it's a role to play. It's just not looking at margins. But the third point is that at the moment of time, there is no much scale. When the scale builds up, I think it will become much more profitable the way the fixed income products looks like now. It's all about scale.
Okay. Now, DP, as it is, there is a lot of pressure on TRs. And on top of that, you have these passive funds which come with a low margin. So what is your view on this?
My view is that we should not look at the margin at all. Reason being because if we are saying that we are responsible fund houses and we are doing for the investor centricity is most important. And it's a volume game. Anything which is sold in big volumes, the margins are obviously have to be lower. So it's high volume, low margin game, and it's not that, and it's a low capital business. So if we look at, keep on looking at what my competitor is making and how much I am making, that's not something. Whether I am able to run my business efficiently, am I earning enough to run my business? The profits are the byproduct. I don't think we should concentrate on profits for pushing any product. There's enough space for active, there's enough space for passives. And we know there's a huge number of customers who are yet to join the bandwagon of investment through mutual funds. I think that's more important thing. Margins are not that important. I think we should be in our mind while pushing the passive products.
Okay. Swarup, is the growth in passives coming at the cost of actives? Is the passive category cannibalizing somewhere the active category?
Not yet. Maybe in the future, I don't know. But India is in this fantastic situation where we have incredible talent on the active side to give alpha generation, though Mr. Singh's data was a little contradictory. I think that is still 4 or 5 years later. But I don't think they're at this. What is happening is, at this moment, India is in a very unique situation. And in our long career, we have never seen 3 generations investing together. Typically, it's been 2 generations. The first is my father, me, and my son. Probably my son will go completely there. My father and me will still stick to some part of active. But before COVID, we were 2.3 crore folios. Now we are 5.5 crore folios. In this new era, you've seen passives going from 2% folios to 16-17% folios. In the incremental market, because of the change in demography, the new age probably are taking there. Of course, the digitization is helping, but I don't think it's cannibalizing yet. They're 2 different markets giving 2 different types of products. Just one view on this margin thing. Margins are going to go. There's no doubt or debate. If you are running a large active fund, so 40, 50,000, anyway, there's no margin there. You've seen squeezing of margins there. We then balance it by other products. Similarly, in passive, there are two products. The market cap products, which everybody can give you, which will have zilch margin, 3 paisa, 5 paisa. The other part is the ideation. If I have a good idea, which nobody can replicate, I can charge a margin.
Yeah,
And the balance of that will retain our margins.
But a challenge in new ideas is that it gets replicated so fast. The intellectual property, you share it with the index provider, even if it is originally, but we'll come to that a little later. Vishal, your views on the growth of the passive, is it coming at the cost of actives? Is it cannibalizing and will it mean that we will have we'll have to live with a low margin regime forever?
Thanks, Prem. So on the first one, is passive cannibalizing active? I might think actually the other way around, which is it may have accelerated the inclusion of more investors into mutual funds as a product over the last 4-5 years, because as in the data I think that you just quoted showed that we've seen rapid increase over the last 4-5 years. And one, not to make a straw man the average or anything like that, but the number of cases of the new gen using passives as the first product to enter into the mutual fund, I think that seems to be quite evident and visible. Now that evolution of you start with a passive, maybe the first product that you bought online, using an app, etc., because someone told you that if you want to enter the market, a passive is almost a no-brainer of a simple product to get in, is great for the industry overall, because that's where the new customer comes in. Eventually, like Swarup mentioned, is his son going to move to actives or have other exotic products or move into other securities? That's a period of time that will finally be shown. But overall, I would think that it's actually accelerated our growth overall. Whether it's active or passive, frankly, for most manufacturers, why should that matter? The second question around margins, I think that is a natural evolution for any industry. If you go with where the customer is, you've got to rework your business model to fit into where the customer is going. If the customer is going into a lower cost, more efficient product, then we've got to rework our maths or our business models to make sure that there's a value proposition for everyone that we can deliver. So therefore, short answer is that no, I think it's actually accelerating the growth of funds overall. And to the margins is effectively something all manufacturers will work out.
Okay. Now, I'll take a cue from what Swarup was talking about. Swarup mentioned that you come out with new ideas, right? But it could be argued that new ideas can get very easily mimicked because it's finally not your copyright. You can't copyright these products. You can't have a window where. So how do you maintain a very distinctive positioning? How do you create products on a constant basis which is very different from that of your company?
So I always said that any financial product can be copied in 24 hours time. I think whether it is banking, whether it is investment product, generally you find in 24 hours you can copy because it is more of transparency. All products what bring in because regulator also brings in transparency. Having said that, once the product is launched, how efficient you run it, it's very critical because especially in passive side, I've seen that the tracking errors, how well you manage the process. It's all about managing the process in the passive side. And as long as you do well, you will find the takers for your products. I have seen similar products giving a different returns. And end of the day, when you look at what went wrong, it's all about the tracking error. I think the differential is all about tracking error. The earlier point what we made about is that all about maturity in the system. We got now 5.5 crores of new folios coming in, and it can be largely from an active side. When active gets much more matured, you will find the passive products also doing well. That's a customer evaluation when you see. And it has happened across the world. It's just not in India. And you started seeing that. And if you look at nowadays, the amount of customers coming to the fintechs for passives is pretty large compared to coming to MFDs. And we have not done a great job on MFDs. Let me tell you that. I think as the industry, as these forums, it's a once in a year forum. And you are the only one guys who's doing the passive forum. Nobody else does this. And we as the industry, we failed to actually build the passive business. We are pretty late. So my view on this, copying, people will copy because it is not, I will never call it as a copy because in 24 hours time, anything can get copied, right? So I think it's very easy to do that. But it's all about your delivery of promise, what you told the customer. And that's what will make a differentiation.
So other than efficiency of processes, how do you maintain a distinction? How do you maintain an edge? When in active, we are very used to giving a compelling story. There's a background of the fund manager. We lionize these star fund managers. How do you here tell anyone, yes, DP, that my product is better than theirs? Don't go to the competition, come to me.
I don't think actually we need to do that. That don't go to competition, come to me. We are a huge country, huge asset base, and huge distribution networks, as well as the niche investors who are coming to you. I think we do a lot of activities. Even if it's a similar product by 5 fund houses, all the 5 fund houses will have sufficient number to come to them. I don't think there's any challenge. If you look at any other industry, look at the pharma industry, everybody is having same thing, different products are there. Everybody is making money for that. And see, it's not that there are only 100 people and only 100 people to be. We have lots and lots of people who are yet to come in. And second, we also have to understand one thing, that the whole ecosystem of distribution is also changing in our country. And it's changing very, very fast. From 100% B2B, it became B2B and B2C. And now today, B2C is equally important as B2B is. And when we look at the numbers, data is telling us that today when we look at the SIPs which are coming into the market, almost 40-45% SIPs of the whole month are coming through the fintechs and which are coming through the direct mode. Because it's the ease of doing business, the trust on the fund house. We need to have many more people having the similar products. I think there's enough space for everybody. That's not a challenge at all.
Okay, Swarup, I come back to your point. What is it that you were trying to tell us when you said the challenge is to come out with new ideas?
See, finally, let's look at the industry now. On the active side, it's laid down. These are your categories. These are your funds. In fact, mostly the portfolio is also laid down. This is a business of ideation. I don't agree to the fact that it should be simple. There should be too few products, because at the end of the day, it's personal finance. And everybody's personal finance is personal. It will be different for different people. Hence, the ideation of new products is very important for any industry to go. Now, when it comes to passives, where there is an investable universe, I can create an index, and through factors can give you multiple, propositions of that same index.
Yeah.
And when you build on it, while we start this industry at an inception stage, it might look at the cost of the fund. I mean, suppose say the Nifty 50 of mine is 5 basis points. Has anybody checked what is the actual cost the investor is bearing after having bought my Nifty 50? Because there are other costs there. It will start as the TER as we call, but it will slowly become a capital market product. It is the efficiency of the capital market, and that is where the growth will happen, will define the future of ETFs or the penetration. If I am 5, the customer should not be paying much more than 5. I'll give you an example. Suppose our FANG Plus is quoting at a price, and because of efficiency in the market and us being closed, the premium is 8 to 9%. We've written out n number of letters saying that don't buy it at 8-9%, but the investor is buying. Look at the volumes. I don't want to quote the volumes, but 8 to 9% the person knows and is giving. In some cases, might not be knowing that. So as these realities start dawning, I might launch a product, but can I be able to efficiently run the product is the key. Launching the product is not the issue. Hence, say, I'm not trying to sell myself, but we've invested heavily in a market maker ourselves. The market making change in the market will drive the efficiency of and that's where ideation will start thriving. It's early days yet.
Yeah, Vishal, the question here is that, how do you go about maintaining an edge? You are relatively a late entrant to the game. So what do you think of, what goes through your mind when your team is coming and telling you we need to launch this fund, whereas competition has already launched these products in many categories. There may be even 10 products ahead of you. So what goes on in your mind? What do you tell your team?
Right. Great question, Amen. It's something that we struggle with, so it's not such an easy thing for us to, lay out as a recipe for success. But I'll tell you some of the factors that we look at. See, one, fortunately, we are in India, which is just so wide and diverse. So to believe that there is only one market and one winning formula, I think that is the first fallacy, because there is enough for everyone. I think some of my co-panelists also made the point that we have the benefit of diversity. So if we can therefore put the customer first and then say, okay, for which customer, what sort of an idea can you actually produce or manufacture, that may still be reasonable in the blue water zone. That is, I would say, the first step. Now, can it be copied? Yes, of course. But, you never start unless you take that first step somewhere. So point is that there are enough cohorts or clusters of opportunities driven by both the nature of the customer, the behavior of the customer, what are they looking for, and the product manufacturing capability, the matching of the idea that a manufacturer can do. And I think every time you can match these two, you have a product that can be offered. Whether it's been done in the past or not may not necessarily be the deciding factor. Because then the other things around things like what is your scale and efficiency, what is your distribution strategy network, what's the ecosystem that you can work with. Is that something that you can actually, this is one of the spams that we all unfortunately get hearing. Okay. So point is that there's enough for everyone, and matching product with customer can offer, I think, many years of growth for all of us. Efficiency and scale will be still something that each of us will have to work on very hard.
Okay. Passive funds started with one very simple proposition, which was simplicity. And today, earlier in the day, one of the panelists shared some very startling data. There are 157 indices on which products have been built in India already. And there are 566 products, I was told. Okay. So where is the proposition of simplicity going? And to this particular audience here, how do they educate themselves about this plethora of indices, the products underlying them, and how do they choose?
Yeah, I think there is a birth of smart beta and thematic ETFs in the market. I think I am very clear that we are not in the stage of recommending thematic and smart betas because the level of education is lower.
Okay.
When I talk to the higher end of the customer, family offices, or the wealth outfits, they talk about smart betas. How do we use smart betas for managing the portfolios? But it is very, very limited. Let me tell you that these are large noises, but when I look back and look at the numbers, I don't think it's quite encouraging. But I am from the camp that if you have to do a passive, do a simple products. And it's very critical. It can be a main part, a core of the portfolio or a satellite of the portfolio. But end of the day, passive plays a larger role. The way we are at the India, I think looking at the market depth, what Swarup spoke about is the largest challenge for us. I think to keep the product simple is very important. I think I always told my teams that we need to focus only on broader indices. It makes much more sense for a customer's portfolio.
Okay.
I think the way the industry will evolve, I'm not saying the smart beta and thematic ETFs will not work. It will work. But we have seen that. And globally, 2-3 weeks back from one of the conferences, people are in US, especially people are looking at leverages.
Looking at?
The leverage ETFs.
Okay.
The single stock leverage ETFs. It is working pretty fine, including my good colleagues. They invest only on leverage ETFs. They don't go pure active but the problem here is that India doesn't understand leverage. We don't understand leverage. Our investors don't understand leverage. It will take some time, but I think there is a fair amount of education required to build that. But having said that, please advise simple products to customers.
Okay. So, DP, my question to you is the same. We started out with the promise of simplicity. Have we compounded our problems by having so many indices, 157 underlying 566 products? So in fact, the choice, making a selection in some ways is a major challenge here. because these products are no longer so simple.
So, I think we should not be overhyped by the number of indices or number of schemes, but even if we look at the overall number today, see, I think top 10 indices will be having 90% of the AUM. I don't have the exact number, but I think 90% plus will be the top 10 indices only. As a human nature, people are in a habit of doing some fancy things. And when you say you have to ideate, you ideate for the heck of it. If I take the example of my own fund house, out of 2021 schemes which I have, the 5 schemes will be having 95%, others some 10 crore, 20 crore scheme just for the heck of it. Somebody wanted that we should have this, just launch it, there's no expense involved. But I think it's avoidable. We should not have those kind of things unless until we do a deep dive and there's enough number of customers there which we can make it. That's the nature, but I don't think we are complicating too much. The time will come when we'll have many more smart beta products. Smart beta products are there even today, and there are some successful schemes also, but numbers are very few. So we should not be worried about there's so many indexes and all, because there are index providers. They are coming out with the ideas. The ideas are being sold to the market, and if they are going to 10 people to sell the idea, 1 or 2 will pick up, and then with the hope that it will, and someday it will pick
up size.
Yeah, because it's completing the bouquet.
Yeah.
Don't be overstressed by the number of.
So, are you driven a lot by this compulsion to complete the bouquet of products?
There is no bouquet of products in passive, unlike actives.
Okay.
The world is your product.
Okay.
Let's be very clear on that. Why are we restricting this question only to passive?
Okay. Because passives are meant to be
Every
simple,
second
that's
there is an NFO in the active side in the industry also. And most of the NFOs don't get money, will not get money. 80%, like DP said, 80% of everybody's money will be concentrated in a few funds, the core funds, right? Then why are we launching funds on the active side? There's no need by that theory. The reason we launch funds in passives because we can actually launch differentiated products. And there is a market. There also this 80-20 will happen. But because of these 3 generations, and I'll give you an example, we launched an EV fund without even an advertising. We didn't even tell anybody. We got 26,000 retail applications.
In which product?
In our EV product.
EV product.
Who invested, I don't know.
Okay.
Because we don't go to a captive distribution. It comes through the broking side. Okay. We don't know. So this whole thing, that bias that we carry, that this is right, that is right, this is the risk profile, will all be banished once the next generation comes in. And that number will outweigh the present number of investors that are there in the industry. This number will not grow. My father and me will not grow.
Yeah.
That will grow. Once that grows, see, it's the only country in the world which has 5.5 crore mutual fund folios and some 12 crore demat accounts. People are going there because we are not giving them something. People are going to Bitcoin because we are not giving them something. We have to give them something to survive, forget success. That's where we are standing. If we don't wake up to that, money will find its own way. We have to, as the risk profile of the investor changes, as an industry, we have to cater to that risk profile. Gone are those days when a 70% large cap and 30% in others is. My son will not, I'm just referring to him, sorry, my son will not buy a flexi cap. And he'll form a fantastic portfolio. He has 5 funds in this portfolio, 3 thematics, 2 very exotic ETFs on his own, and I'm not involved in that. But that's where it will go. And once the numbers start playing out, the need for more products just to retain a customer and then probably cross-sell your core will happen. That's what every financial services does. But I take exception to this question being only referred to passives because actives also launch enough funds which are not needed.
Okay. So, Vishal, your views on the fact that there is a multiplicity of products making it very difficult for distributors to understand, leave alone the investors. How do you respond to that?
So I wouldn't agree to start with, because I don't think, I think it'll get even more complicated. So we're just getting started. And I don't think, at least the people I meet, that they're confused about, I have too many passives to choose from, or I have, too many funds to select from. Because I think we have to invert this thought and say, look, what is your investment thesis? What is it that you think will do well? And I think I echo some of Swarup's points. The new age investor is, right or wrong, we shouldn't be judgmental on this, is making those calls very actively, right? Now, after that, you're looking for either a product which is efficient, which is convenient, which is quick. And, we've seen some of the data on stock trading and other exotic products, etc. That's where they're also going to, right? Now, if you have a good idea and you think, okay, for, ABC reasons, X, Y, Z will do well. If a passive product offers you an access to that XYZ theme, why should it not exist? So from a pure customer service standpoint, I think that will continue to happen. As economies evolve, more themes will come up, more investment opportunities will come up, and therefore more passive will come up. This is natural. I think it's just started. So yes, I think going back to what DP said, currently there is a large amount of assets in the broad-based indices because that was maybe a very different market. There's an institutional market. There is a very, very evolved, very safe and steady. I just want to buy the Indian market type of a customer who's saying just buy a passive. It's most efficient. It's most cost effective, etc. And there's a good reason to do that. But then there is a new group of investors emerging, which is very sure about what they want. And here the need of the product is to satisfy that investment thesis in a very efficient way, which is where I think a lot of the indices are getting created. Now, that's not just it. There are also investment teams that are saying, okay, I think this will do well. And by the way, I cannot do this in an active format. So why not a passive format to be able to satisfy the need or the idea of that investment theme? I think these are two areas I would watch out for. So I do think personally that thematics and factors will continue to grow. In fact, combination of those are already starting to happen because this is now, as part of any evolution, things getting sharper and more bespoke in some sense to more accurately satisfy the specific need that your new investor is looking for.
Okay. Now, let me switch gears. The audience here is largely distributors. And with passives gaining so much of traction, how should mutual fund distributors adapt their approach and value proposition? And how should they reposition themselves?
I think the first point which I made is that we as industry has not done a great job in terms of educating on the passive segment. Let me be very clear. Maybe the first question about profitability, margins, all these things are part of it. You can tell that the world that should not worry about margins. Yes, obviously, sometimes you get listed, you guys quarterly. As CEOs, we get into stress on margins. We can't run away from the stories. Having said that, I think there are steps done now where a lot of education has happened in terms of passives. But I think it is just 1% of the world helping the Indian investors on the passive side. Second point is that we are taking for granted saying that the new set of investors will come and do passives. As long as we don't do education, that doesn't want to happen. That just doesn't happen. I think I'm very clear about that. I think from a distributor perspective, I think there is an effort made to make sure that there's enough awareness created in terms of the products what we manufacture and tell you guys to advise. In my belief, I spent enough time in my life doing advisory, not manufacturing products. I think one of the things about passives is that the biggest debate is whether it is a core of your portfolio or it's a satellite of your portfolio. I think that's a debate.
Yeah.
I think that's a call you need to take some point of time, looking at a customer allocation and a customer's risk profile. There are advisors I have seen that have even 5 active schemes. The customer alag kya pooch raha hai, iske liye main ek passive de raha hu. I think these are all not rightly to do. I think we need to think about whether it be a core or a satellite of a customer's portfolio. I think that's the discussion we should have. I think we as industry has to work. I think Vishal is in the part of AMFI. We should see that how do we develop this market, how do we educate. Mutual fund sahi hai, active sahi hai, SIP sahi hai, but how do we make sure that passive SIP bhi sahi hai? I think we are not talking about it. In the earlier panel, people talked about how can we build product which is competing for an FD. I think there is an answer for a debt passive fund which are much more superior than your fixed income, fixed products like FDs. which are our competitors in our industry, how much we are doing about it. I think we need to think as industry. I think we have not done enough.
DP, so far we focus so much on fund performance. We focus on the track record of the fund manager. We focus a lot on a distinctive investment philosophy. And distributors have been conditioned to identify products which they believe will deliver a superior performance, which will generate alpha, which will beat index. And now you have a product category where none of this applies. And all that you're promising is a certain degree of consistency and reliability. So how do these people here who've been taught day in and day out to sell in a certain way now adopt to a new approach, which is very different, antithetical to active selling?
I think, see, there's enough space for active even today. That we have sufficient, at least for the next 5-10 years, there is good stories which will emerge, and the fund manager will definitely, the kind of talent we have in the country, they will continue to create alpha over the period of time. At the same time, there's a traction for the passive funds, and passive fund doesn't mean only ETFs or 2 or 3 paisa ETFs. There's a good number of index funds where, yes, margins are low for the manufacturer, margins are low for the distributors, but a good mix of active and passive have to start with if we are starting the journey on passive today. And then there are enough number of places. There are fund of the ETFs. Of course, in those cases, the margins are a little less. But see, we also have to learn. Globally, people have learned to ask for fee. The biggest problem in our country is the investors are not ready to pay fee. But some of the very, very successful investment advisors are still running their businesses on fee only. It's not that it doesn't exist. The systems are changing, the ecosystem is changing. I think we have to change along with that. I say it's the time when active, you cannot shy away from the actives, and people are putting money in active. There's enough number of people who are ready to put money in active funds today, but it has to be the way we as manufacturers, we are also knowing that our active percentages will come down, passive will go up. It will be a balance of active and passive both. The same way it has to replicate into the portfolio of a distributor, that his active and passive, the growth has to happen, and it has to happen in a balanced way in active and passive, and to start with the active, this index funds. That's
Swarup, you have a pretty long lineup of ETF products. You were relatively one of the earlier entrants, and when you came into it very seriously. You launched a plethora of products. What would you tell this distribution community about why they need to sell ETFs when there is no business case for it?
Prem sir, I do a 20-minute presentation on this answer. You give me 2 minutes, so I'll try. First of all, this business is of increasing conviction and decreasing bias. The person who does both simultaneously grows. In our industry, there are 133,000 MFDs. 131 are below 100 crores. And only 344 are above 500 crores. That's data. The people under 100 crores run this huge bias for whatever reason of active equity at 80% allocation. The person who is above 500 crores decreases this bias and moves the advice to the client's risk profile by only 60% active equity. The person who moves the advice more to the client increases wallet share. There is only one rule to this business. What is right for the customer is right for us. If you think through, all of you are qualified to know what is right for the customer. If you think your revenue is more important than that, you are already dead. Already dead. The customer, once the customer's money moves to the second generation, your AUM is already gone. Trust me. And all of us are sitting where the father is probably inheriting that to the son or probably whatever. So don't take the AUMs for granted in this incredibly changing world. Go by the merit of the portfolio. Don't make the product the king. We are ready to be the king because we are the product manufacturers. When you look at it from a merit of that portfolio, these products become incredibly important. Whether core or satellite, you decide. You are the owners of that portfolio. But if you were to do justice and increase wallet share, guys like me who were stood up on these stages and would have said equity is a growth asset class was fine. I have said equity is the only growth asset class today when gold is beating equity on a 10-year horizon. I don't know where to hide. Why is my allocation in gold less than 10%? That means we've not done justice to the client portfolio is a reality. Once you wake up to that, you know the business better than me. As simple as that. Then you will find merit on your own. Active, passive are all subsidiary. The client's portfolio will cater to the solution itself, is by submission. So don't cut out bias. Go by the merit of the product. If the merit is good, take the product. Revenue happens if you own bigger wallet share, not by selling a simple product. That's the answer to this business.
Okay, Vishal, I'll come to you. How should distributors adapt to the new reality? And how should they reposition themselves given the rise of passive funds? Because if they don't sell passive funds, उनका पड़ोसी जरूर बेच देगा.
Right. I think so. I think many very good ideas already on the table. See, firstly, I don't think it is a reality any longer that distributors are not selling passive funds. Look at this room; it's packed. So clearly there is an interest in passive funds, and I think the data that I see, maybe 5 years back, it may have started with, like I said, institutions and maybe direct customers coming to passives. And over time, there were some advisors, very sophisticated advisors, who said that I can add value by doing allocation, and the underlying can be a passive. So therefore, it is good for everyone. I get a fee for doing the allocation. The underlying product is a very low cost, very efficient way to provide that portfolio, and the customer is happy because it's still managed within a reasonable cost. But today, when I look at some of the growth rates, I think the MFT world growing in index products is very rapid. Second, so the belief or the fallacy that, mutual fund distributors don't sell passives, I don't think is true any longer. Second, passives don't make money. Look again. Would you rather participate or sit out of a product that is growing 2 to 3x of the broad industry and is giving you half the margin maybe, right? So would you rather go for 3x volume and half the margin, or just stay at the high margin product, which is actually clearly not growing as fast as the opportunity is? And I think every trend is telling you that the next generation is going to move to that. So if you're not moving there, how will you sustain and grow your business? So I don't think it is any longer the reality. Of course, it has to percolate a lot deeper. And for the smaller or the newer distributors who are saying, okay, let me start first with a meaningful revenue pool, which is coming through the active products, etc. Maybe that's a choice you make, but I don't think the margin is something that is so different, at least at a portfolio level, that you should sit out of it, especially in an index fund. So one of the pivots we had, that we said, look, ETF is something that is largely traded through the stock exchange. Most mutual fund distributors are very happy to trade through the mutual fund process, and index fund works very well there. It's very familiar, and we've seen a lot of growth in that sense. So I don't think it's just a matter of where you are in the process. I think the start has already been made. It is just going to build up very, very rapidly in an exponential manner, and that's where I think this industry is going.
Okay. Now we have very little time left, so I'll ask a very simple question, and it relates to your own AMC, to each one of you. How is your AMC supporting distributors in selling passive funds?
Yeah, I've been harping very word called education. I think we're doing a lot of work around that, especially all the MFDs. When we look at the distribution network, the digital one piece is doing fairly well in terms of understanding, putting the data properly on the. We do work with a lot of fintechs, get the data right on the fintech platform, which is an education material and all this thing. I think one of the initiatives we have taken is that how do we approach MFDs and be a part of most of the conferences. For example, today evening we are doing conferences, we'll have web patches as a segment. It was unheard in our system. Yeah, over the last 15 years, when I go back and see what are the agenda, it's always active. I don't think we never spoke about passives. I think now the passives has become from a dining table conversation to the breakfast table conversation. That means it starts from the morning itself in our organization. So I think that's a change what we brought in. I think you'll see a couple of more products what we're going to launch very shortly on this. We filled our product basket now last 1 year. I think it's more of now getting educated about these products which is available. But I continue to say that we as an AMC will build the most simplest products. We don't want to complicate products for a customer's portfolio.
DP, how is SBI Mutual Fund supporting distributors to sell passive funds?
Well, we are aware of the fact that acquisition cost is high today, and how to make it easier for the distributor for the more and more number of customers with the digital solutions, and that's where we have to, first is educating the distributor so as to enable him to educate investor about the pros and cons of having a passive product, and second, absolutely giving whole lot of digital platforms so that they can many more number of people, because we feel this has to be high volume game because the margins are low and we have to work together. We are continuously working towards that.
Yeah, Swarup, how is your AMC, Mirae Asset, supporting distributors in selling passives?
I think for us, it's been a journey. When we started talking about passives to MFDs in particular, quite honestly, we took a lot of flack.
You started your passives business at a time when your active was doing phenomenally well.
Yeah, I mean, they're two different businesses and they are not related to each other. I think that today has taken a very different shape. If I take out two large institutional investors from our AUM, 30% of our AUM comes from MFDs, right? And that's a story in itself. There are some back-end issues on people moving from non-demat to demat. We're trying to form solutions with our two broking firms that we have. If we, I think, give that, some of the worries are money is not in my control if I move to a demat. If we can give a back-end support to MFDs on that and they have control of seeing the money, I think a lot are on the fence wanting to do this business. Gone are those days when people did not want to do this business. That's a journey in itself, and I see the transition happening very quickly. There has been some very good feedback from that side. A lot of work. I think Gop has put it very bluntly and rightly. From the industry side, we need to be more vocal about this product. Why is a guy speaking passive taken very offensively from that side? I do not understand. They're incredible products on both sides, and that is somewhere getting to a place where people understand the merits of both sides. But there is some homework given by the distributors to us, and I think we are working on the back end to come back and give some solutions. As long as this two-way process of communication goes, I think we can build a great case. But it's been 4 or 5 years of talking, and I think it's been a very, very learning experience from that side here, and we are working on every aspect on it to come back and give more and more solutions to MFDs on that. We continue to educate and why this product can increase wallet share for everybody. And once somebody increases the wallet share, revenue falls into place. Revenue is always in mind. Let me give you a very interesting statistics. Please bear with me when I say this. When my Nifty 50 was 1,000 crores only, our margin on passives was 32 basis points. Our margin on actives was 36 basis points. So it is not a low margin business. You can convert that by doing various multiples at your end. We can discuss this whenever you want.
Yeah, Vishal.
So, see, firstly, I think there is one very good thing in our industry that the industry talks in one voice. And I think it is not for any one AMC to be able to really propel something that can be a movement or is already a movement. So I think all of us talking together and forums like this, the media helping out, journalists helping out, etc., I think is one way to get the message and some of the misconceptions around passives cleared out. So that I think is already happening. Gop mentioned that at Amphi, if there is more advertising, maybe that will help. But there is all of us talking in one voice, I think helps. And all of you talking in one voice about propelling this product ahead, I think that helps. At Bandhan AMC, we try and do what we think we can help out with. And traditionally, we've tried to make interesting learning and development programs, gamify some of the concepts, come out with unique ways in which you can understand some of the nuances better. So those things we continue to do. So we have some great material that we try and put out and share with the community that is interested. So those are smaller ways in which every EMC is coming together. But I think it will happen only if all of us speak in one voice.
Okay. So with that, we come to the end of this session. The panel here has been very frank, very forthright. What we understand from them is the fact that they're very committed to growing passives as a category. They're very committed to helping the distributors grow this particular category, and I think that means well. Today, we are talking about a 17% share of the total AU. Maybe by the next Cafemutual Passives Conference, it will be 20 or above. So thank you so much. And thank you, audience, for giving us your patience here.
Absolutely phenomenal thoughts flowing from our stalwarts. Thank you for sharing your knowledge with us.